Today, we're going to update you on my portfolio and its performance against the benchmark. We're also going to look at my top performers and worst performers. And then we're going to look at three stocks that I believe will be important to be on all of our radar screens for the month of December. With that, let's get started. Hey guys, welcome back to the channel. My name's Kevin Burgess. If you're not familiar with the channel, my channel really focuses on dividend growth investing. Every individual stock that I hold in my portfolio is a dividend paying stock. I believe in dividend paying companies, and so therefore I focus only on those stocks. If you're interested in seeing how my portfolio does, stay tuned because we're going to talk about the performance of my portfolio against the benchmark. I use SCHD as a benchmark for my portfolio. I believe it's important for all of us to pick a benchmark to measure our performance against, because otherwise we won't know how well we're performing. Some of you may consider using the S&P 500. I did that for a long time. But given my place in life where I've retired, I'm looking for some income from my portfolio. I think it's more important for me to benchmark against an income producing fund. And so therefore I've chosen SCHD as that benchmark. We're going to compare my portfolio's performance against SCHD. We're going to look at the top 4 best performers for this week and also the top 4 worst performers for the week. And then after that, we're going to talk about 3 stocks that I think need to be on every dividend growth investor's watch list as you go into the month of December. So before we get started, take a moment to like this video and let people know that there's good content in here. As well as if you haven't subscribed to the channel, consider subscribing to the channel. I'd love to have you along for the journey. So with that, let's get started. So our first task is to look at the portfolio performance. Our portfolio for this week was up 0.77%. Now, compared to SCHD was actually up 0.93. So they beat us this week. They get the green marker here. But in 1 month, we were up 6.43%. SCHD was up only 3.64. For the 3-month period, we were up 1.89%. SCHD was down 0.77%. On a year-to-date basis, we were up 11.24%. However, SCHD, not so good, down 2.38%. The 1-year numbers, 12 months, is we were up 6.72%, and SCHD was down 4.90%. So overall, we had a good week, but we didn't do as well as SCHD. But again, this is a long-term game, so we're going to keep playing the game, and as long as we win on a long-term basis, I'm happy with where we are. Now let's move on to the top performers and the worst performers. You can see that for the week, Medtronic was the top performer. It actually returned 5.63%. Johnson & Johnson returned 2.6%. Microsoft, one of my largest individual holding, as well as the largest exposure that I have in my portfolio, was up 2.05%. Hess Midstream, which is a stock that I have let people know about on my Instagram channel. So if you're not following me on Instagram, please do that. And it's a place where I don't post a lot there, but when I see something that I'm really, really passionate about, that's where I will put it. So if you're on Instagram, just look me up, Dividend Investing with Kevin, and just follow me there and you'll see these posts. But I did let folks know about Hess Midstream. It has performed very well over the last couple of months. So it was up this week 2.04%. Now moving on, we see that Whirlpool was down 2.94%. Kilroy Realty was down 2.4%. Lowe's was down 2.27%. And US Bank was down 1.17%. So now I want to talk about the 3 stocks that I think are important for all of us to have on our watch list for the month of December. Let's talk about the first one. It is RTX. RTX is the old Raytheon Corporation. If you recall, Raytheon United Technologies did a merger of equals back in 2020. We're looking at Raytheon, which is part of that merger of equals. Morningstar says that their fair value is around $112. This block here tells me a lot that I need to know. One is that it's trading at a 29% discount. In addition to that, it tells me that they have a wide economic moat and that their capital allocation, that means what they do with their capital that they generate from the business or borrow or get from shareholders, the allocation of that capital is exemplary. So those are things that we want to look for in our stocks. The other thing that I will point out is that they have a $10 billion stock buyback that was announced at significant discount to the $112 valuation. So RTX is buying back $10 billion worth of their stock while the stock is significantly undervalued. That's a key point that we want to look for in a management team is when the stock is undervalued, they're buying back their shares. If it's overvalued and they're buying back shares, then it's not something that we really like, but we do like it when they're buying back their shares when they're significantly undervalued. So let's take a look at Simply Safe Dividends and see what they say about it. You can see here that they have a dividend yield of 2.95%, dividend safety score of 70. They're trading somewhere around the $80 range. You can see here that in my portfolio, the cost is around $74 a share, $73.89. And I have basically 100 shares of this. I do want to increase my exposure to this company. So right now I'm at an 8.2% gain. I'm looking for RTX to pull back a little bit. I'm hoping that they will pull back a little bit, and then I'll enter into some more shares. One thing to remember about RTX is they are not simply a defense company. They have a piece of their company that's defense, but they also have commercial operations as well. Gives a nice blend of public versus private customer base. Now, I want to talk quickly about their dividends. You can see the last 5 years is negative 5%. They're a negative 5% CAGR. This would typically alarm me, but I want to share with you that they entered into this merger of equals and traded business units around with United Technologies. Therefore, the historical numbers are not the same company as what we see today. So what we really want to look at is starting in 21 because the merger actually occurred in 20. So 21 and forward, you can see that there is an increase in their dividend. Let's move back up to where that increase shows as a 7.3% increase in April of 23. That's very important. And it says they have a 1-year streak, but we all know that it kind of started back over with this merger of equals. So I'm not concerned about that either. You can see that they also have historic dividends showing here. It's a bit confusing to say that they have a 1-year growth streak when they're showing 3 years here, but it's because of this change in company ownership. Let's look at their payout ratio. They're trading at around a 45% earnings payout ratio. Again, I'm only looking at 21 and 22. Historic numbers aren't that important because it's been a remade company. They are below 60%, so that's a good sign. They're also moving under 60% in their free cash flow payout ratio. That's also a good sign. Earnings per share is growing, and you can see, starting in 21, it is growing in the new company. Return on invested capital is low. It's at 4% over the last 12 months. It's 7% in 2022. If you watched my live stream this past week, you'll know that sometimes we invest in companies that have a lower return on invested capital, because what that means is they have a lot of capital invested that they can then turn around and get more earnings with that. So I'm looking for the management team to unlock value. That's why I think it's a really good buy right now for the long term. Looking at their net debt to capital, they're around 0.3, 0.28 at the end of 22, 0.31 currently. And their interest coverage ratio is a little light. I'd like to see that come along up above 8. But, we'll keep an eye on that. I'm not overly concerned about that. So the next stock on our list is U.S. Bank. Now let's take a look at what Morningstar says about U.S. Bank. You can see that the fair value is around $52. They have a wide economic moat as well as an exemplary capital allocation. Those are the things we're looking for. And it is trading at what Morningstar believes is a 28% discount. Moving to Simply Safe Dividends, you can see they have a relatively high dividend yield of 5.16%. They are considered borderline safe. They are a bank, so there's a lot to think about there. But I'm comfortable currently with that 55 rating. You can see that my average cost per share is around $33.93. It is trading today at $37.20, so I've got about almost a 10% gain on that. I am going to wait for shares to drop back below 35 before adding more. Now, one thing to keep in mind about U.S. Bank is that they've not raised their dividend lately, so it's considered very slow. Over the last 5 years, they've grown it by 10% per year. And as we look here, their dividend growth streak is 12 years. They've had an uninterrupted dividend streak of 13 years. And moving down here, you can see that they were at 42 cents back in 21. They jumped to 46, then went to 48 cents in October of 22, and they stayed consistent in October of 23 at 48 cents. Let's take a look at their earnings payout ratio. It's down around 50s to 49, I guess, over the next 12 months. Their free cash flow payout ratio looks really good. And many of the other metrics that I typically look at are not applicable to banks. So I like U.S. Bank as an income-producing, dividend-paying stock. So I'm okay with having slower growth as long as the dividend yield is above 4%, and it happens to be above 5% for U.S. Bank. So I'm really interested in using that to kind of grow my income stream in my portfolio. Moving on, let's take a look at the third stock, and that third stock is CME Group, the world's leading derivatives marketplace. Now let's take a look at what Morningstar says about CME. They say their fair value is around $215. They're currently trading around $217. I typically would want to wait and let the price come down a bit from here. It is at fair value. We see that the economic moat is wide and their capital allocation is exemplary. So we're looking at something that's trading in a fair value range. Its moat is wide and it has an exemplary capital allocation. Let's move on to Simply Safe Dividends. Simply Safe Dividends says that it has a 96 safety rating, very safe. Their dividend yield is 2%, which is not a very high yield until you look at a few other things. So let's move down and look at my portfolio. I only own 25 shares. My cost right now is $189.80. So I've got about a 14% gain on these 25 shares. It's only $5,000 or 0.4% of the portfolio. I'm looking to get this holding to be higher. CME Group, if you're not familiar with what they are, they operate contract markets for the trading of futures and options on futures contracts worldwide. Now we can see here their latest dividend increase was 10%. That was back in February of this year. Their last 5 years, they've grown at 9%. So they've got a large growth over the last 5 years, and it's even larger in 2023. They've got a dividend growth streak of 9 years, and they've paid dividends for 19 straight years without a reduction. Now, here's the thing I want to point out is that they have an annual special payout. Now, they've paid this thing out for several years now. So it's important to think about this special payout because it is done typically the ex-dividend date is near the end of December. It pays out in January. And as you can see on the screen here, last year it was $4.50. So the numbers tell me that it might even be a little bigger than that this year, but let's just assume it's $4.50 for 2023. That means whatever shares you hold, you will get $4.50 in dividends as a special payout from CME. Now, one thing to keep in mind here is that the stock price will typically drop by the amount of the dividend. Anytime a dividend is paid from any company, the stock price typically will drop. It is my opinion, only, you can do your own research. It is my opinion that while this drop will occur when the dividend is paid out, I believe it will return quickly. And so we will therefore end up with the dividend. Plus, if we give it a little bit of time, it'll recover that $4.50 for us. I do plan to add a little bit more of CME, especially if it dips a little bit, maybe below the 215 fair value. So I'm looking at this stock to add before this ex-dividend date that has not been announced yet, but it is coming. Oh, and if you're interested in using Seeking Alpha, I do have an affiliate relationship with them. You do have the opportunity coming up to save 30% on Seeking Alpha's subscription for this coming year. So if it's something you're interested in, I'll have the link below in the description, so you can just click on that link. It will provide a few dollars or cents, or I'm not sure how much, to the channel, but I do want to share that with you because I think it's a great deal. And if you're looking to enter into a premium subscription with Seeking Alpha, this is a great opportunity to do that. So with that, I hope you have a great weekend, and I will see you on Monday night.